Warren Buffett's new ETF, OMA, can make you richer than JEPQ and JEPI. Yes, you can now invest just like investing legend Warren Buffett, but with a twist and different spin. Instead of investing in Warren Buffett stock of Berkshire Hathaway, ticker symbol BRK.B, you can invest in an ETF just like Warren Buffett with a monthly dividend ETF. Vista Shares Target 15 Berkshire Select Income ETF, ticker symbol OMA or OMAH, is the newest monthly dividend ETF that could rival other high-quality covered call monthly income ETFs just like JEPI, JEPQ, QQI, SPY-I, GPIX, GPIQ, and so much more. In this video, I'm going to give you a full and complete breakdown of OMA ETF, as well as the pros, the cons, the good things, the bad things, the risks, and as well as who should invest in it, if it's a great ETF as well, and so many other things, including if it's a better investment than BRK.B, Berkshire Hathaway stock, as well as if it's even better than other high quality cover call ETFs just like JEPQ and JEPI. Now that was a lot, so let's get started. 3 reasons to consider investing in OMA. Well, for one, it seeks high monthly income generation. The ETF does this by investing in a diversified equity portfolio and implementing a data-driven options investment strategy. Number 2 is that this ETF offers core equity exposure. OMA provides large and mid-cap equity exposure that can be considered a portion of a core equity allocation in a well-diversified portfolio. And lastly, number 3 is professional options management, where investors can leverage the years of experience and rigorous research process employed by the team managing Vista Shares option-based income ETFs. Okay, so it took away these 3 different things from reading that prospectus on OMA, so you should also know about it right now. Okay, so first off, this is a great ETF for those looking for high monthly income. So if you want monthly income, this is for you. And then number 2, this ETF should not, I repeat, should not be the only ETF you invest in, because just like owning any other ETF, just owning this one does not make you truly diversified. So you should also own other great ETFs to make you a well-diversified investor. For the love of everything good, don't only own this ETF. It's not the most diversified when you think about it. It only has a few different companies that are kind of like handful. It doesn't have every sector of the stock market. It doesn't have hundreds or even thousands of stocks like other ETFs that are broad market. S&P 500, even traditional dividend ETFs, you get the point. So think about other high quality funds like the ones on your screen for extra and even more diversification. I should also mention that this ETF is for those who want sweet, juicy monthly income. So if you want capital appreciation, if you want long-term growth, this ETF is not for you. It's if only you want a dividend every single month instead of taking in that long-term capital appreciation in the future, like with a traditional stock, just like BRK.B. So if income is your priority, then this ETF is for you. Now, if you also like BRK.B or Berkshire Hathaway's original stock that does not pay a dividend, this one can be for you, because if you want dividends, this is great for you. However, you should know that there's a trade-off. There's always going to be a downside to taking in monthly income. You're going to be trading off dividends for upside. I know, I'll get to that in a moment. But yes, sweet, juicy monthly income. If you want this is for you. Okay, so a covered call strategy like OMA limits your upside. I repeat, limits your upside. So yes, you might be getting some of those sweet, juicy dividends, but by limiting your upside potential and taking in premiums, you will not, I repeat, you will not outperform the underlying asset it tracks, which is Berkshire Hathaway, BRK.B. Now, the reason why is because Berkshire Hathaway, of course, does not take in covered calls or does not write or sell covered calls on the underlying stock. So you will have better long-term returns with, more upside. You'll have less tax generations from all the premiums, so much more. But just, yes, if you want to have the best returns possible, BRK.B is your go-to. But if you want the best monthly income, OMA is your go-to. Also, people forget about taxes. Taxes, everybody's favorite topic. I know, but people forget about taxes. Now with OMA, you're going to have more taxes, higher taxes than owning something like BRK.B, the original stock. Reason why is these covered call strategies generate what's called unqualified dividends, which have a higher tax implication. So you'll be taxed at a higher tax rate versus traditional dividend ETFs like your SCHDs, your VYMs, your DGROs, your VIGs. those will be taxed at a qualified dividend at a lower tax rate. So just know that dividends aren't free, but they can definitely be used as an awesome way to use as passive income and to pay off some expenses as well. So to sum it all up, OMA will have higher taxes and higher tax implications than just buying Berkshire Hathaway BRK.B. It will also not outperform, I repeat, not outperform BRK.B in the long run. And also, it's for investors who want monthly income in their portfolio rather than long-term capital appreciation, so dividend lovers will love this new ETF and find a home in OMA. Okay, so we have the ETF summary. The Vista Shares Target 15 Berkshire Select Income Fund offers investors a core equity portfolio that generally mirrors the 20 largest holdings of Berkshire Hathaway BRK.B, as well as providing exposure to BRK.B directly while leveraging the experience of the portfolio management team to seek to generate high monthly income. Okay, now we have the ETF objective, which is that this is an actively managed fund, so you'll have, higher expense ratios, more taxable events, but that this fund seeks income and then secondarily long-term capital appreciation. Okay, so did you catch that? Write that down, highlight that. It says first is that it seeks high monthly income or high income, and then secondarily is that it seeks to provide capital appreciation. So the primary goal of this fund is for those who love high monthly income, so great, but it will be its secondary choice or secondary preference of the goal to generate high capital appreciation or long-term capital appreciation in the future. So if you want the best return possible, BRK.B is your move because you have a non-covered call strategy on your individual stock. Now, if you want monthly income, OMA. So hopefully you guys understood that. But yes, long-term capital appreciation is definitely going to be better with BRK.B, but monthly income, OMA. The fund strategy involves two components. Number one is investing in a portfolio of equity securities based on the solo active Vista Shares Berkshire Select Index. And then number two is that it generates income through an options portfolio that basically targets to achieve an annual income target of 15% distributed monthly. Okay, so what's cool about this fund is that it provides investors with an annual target of a 15% annual income, which is awesome and great. So if you want a high dividend yield for an annual dividend yield of 15%, this can be great for those who want great high monthly income. But that might sound too good to be true, and it might, because it says a 15% annual income. It doesn't say 15% total return. So this just says, hey, we hope to provide 15% annually for the dividends paid out, from the yield. It doesn't say total returns, which also factors in capital appreciation. Now, you can also factor in stuff like taxes, expense ratio, you get the point. It can all be avoided in a Roth IRA. But yes, total returns is what matters. But hey, 15% income, great. OMA's top holdings are just like Warren Buffett's holdings from Berkshire Hathaway, Apple, American Express, Kroger, VeriSign, DaVita, Coca-Cola, Bank of America, Visa, and Citigroup. The expense ratio of OMA is really high, honestly insanely high of 0.95%, literally almost 1% for the expense ratio, which is honestly kind of highway robbery, but I'll give that a zonk, and it's one of the biggest downsides in my opinion. Okay, so this is my favorite part. We're going to have an ETF battle of JEPI and JEPQ versus OMA versus individual stock of BRK.B in a full-blown battle for the best investment for the next 10 years, 20 years, 30 years down the line. It's going to be a great and epic showdown. Okay, so the scorecard is going to be diversification, dividend yield, dividend stability, expense ratio, total returns, and taxes, and then I'm going to rank and crown the winner. So let's get started. In terms of diversification, I'm going to have to give this point easily the first point is going to be to JEPI and JEPQ. Reason why: they track well-established indexes like or they at least try to mimic it, like the S&P 500 and the NASDAQ 100. So these are well-established, more diversified, broad baskets of stocks. They have like 100 plus companies in each fund. So easily JEPI, JEPQ, first point on the board. In terms of dividend yield, that's easy. OMA has the highest dividend yield, or at least projected 15% dividend yield for each year, which is going to be higher than JEPI, JEPQ, and even BRK.B, of course. So OMA gets its first point on the board as well. Next up, we have dividend stability. Gosh, that's a tough one because JEPI and JEPQ have kind of a volatile dividend or income payment, and OMA is a new fund that's like a month old. So we don't even have that much like at least history or data to really analyze the dividend payments. And the BRK.B has no dividend, but I will say that other alternatives to JEPI and JEPQ like QQI, SPY-I, GPIX, GPIQ, etc. have more stable income payments, which are great alternatives. So with that in mind, I'm going to give this point to JEPI and JEPQ because there are other great alternatives to these two ETFs. So JEPI, JEPQ get another point on the board as well. In terms of the expense ratio, of course, JEPI and JEPQ have the lowest expense ratios by a wide margin compared to OMA of a 0.35% expense ratio. Of course, BRK.B doesn't have an expense ratio, but they also, that one gives you exposure to Warren Buffett's investments. So with that, I'm going to give JEPI and JEPQ and even BRK.B a point on the board right now. Moving on to the total returns of these funds, OMA has only been out for a month and BRK.B has been absolutely kicking everybody's butt. And even in the long term, since Berkshire Hathaway stock does not have any covered calls on it, of course, so BRK.B will perform the best long term, I can almost guarantee it, even compared to both the JEPI, JEPQ, and other covered call ETFs. So with that, BRK.B gets a point on the board. And lastly, we have taxes. Now, BRK.B will have the best tax implications. If you hold this fund, like buy and hold forever, you will have less taxable events than if you buy something like JEPI, JEPQ, other covered call funds, and even OMA. So with that one's easy. BRK.B will get another point on the board and win the tax category. Coming in first place in a tie, yes, so we have a tie right now of BRK.B with 3 points. And then also coming in tied for first place as well, we have JEPI and JEPQ at 3 points. And then coming in third place, Warren Buffett Vista Shares ETF. Also, it's kind of cool to see that Berkshire Hathaway has been performing way better than OMA, just like I've been saying, because it's a covered call ETF versus a non-covered call individual stock. Now, my final verdict is that this is a great fund. At least the concept of it, it's a new fund, so the liquidity will be super low, like really, really low, which is not good. But I think investors should take a couple of months to see the income, see the volatility of the payments, to see if it's stable. They should wait to see the returns versus Berkshire Hathaway. They should just wait to see, and maybe Berkshire Hathaway will fall more. OMA could get a lot cheaper, so investors could get a better price for their fund, and just so many different things. Please do your own research, do your own due diligence, and just take the time to just relax, let it sink in. This is a great idea, a great fund. Hopefully, with the next maybe 6 months of data, we could see the payments, we could see how this fund performs versus BRK.B and other high quality covered call funds, and so much more. So don't pull the trigger just yet, in my opinion. Wait, give it some time, because it will be, we have decades to invest. So my opinion, just wait. But hey, if you want to buy it, buy it. But hey, if you don't want to buy it, don't buy it. Now, if you guys like this video, please give it a like and subscribe, because this cute puppy did. Now, have you ever wondered how many ETFs should I actually own? Well, I answered that question right here in this video. So go ahead and check that out. I love you guys so much. Continue to crush the stock market and take it easy. Peace.